The broadcast is now starting. All attendees are in listen-only mode.
Good evening, ladies and gentlemen. Sorry to be a minute or so late this evening, but thank you very much for being with me this evening, and thank you, Tony D. Welcome to you, my friend, up in Chicago. And Mickey D is with us, and he says, loud and clear. I'm glad all is good. And Mick had a pretty sensational trade over the full moon, which I talk to you about periodically, how markets, particularly the S&P and silver, seem to be locked onto the blue moon, onto the moon, I should say, the full moon in particular. A number of occasions we've seen that. It's a pretty high correlation. Thank you, Norbert. Welcome to you up in the really seriously cold country in Canada. My son's just been in Canada on a holiday. And he got all the way up to Yellowknife to see the aurora borealis. That's the word I was looking for. What's Mick got to say? Nice rally, but it's running out of puff. Yeah, really interesting what the markets have been doing. We've been running out of puff because we found so many winners. We got to the stage by Wednesday this week that they were really hard put to find any Forex trades. We'd got them all, and much the same with the other markets, equities and commodities. So anyway, good evening to you folks. Good morning to our friends on the east coast of Australia in God's country, that's Queensland. Good afternoon to most of the rest of you who are on daylight saving, and of course good afternoon to our friends across the ditch in the land of the long white cloud. Wonderful stuff. So our message for this particular webinar is your doom, my honey. And we've got most of the honey out of the T-bond trade that's just been going on and on with hopeful rallies that are being thwarted and refused. And we're going to talk much more about that as we go forward. As well as that, we're going to talk about the wonderful excitement coming on Monday when Donald Trump will have his inauguration second time around to become the President of the United States. So that's going to be great fun and really interesting too. So let's move along a little bit as we go. So here we are. Good. So what happened in 2024? Well, we're still in the very early stages of 2025, and this is a slide you've already seen. I said our mission is to make you rich through the trading of financial market derivatives, and traditionally that's meant futures and forex, but in the last year our work has now extended to crypto, ETFs and stocks, but if you're not trading one of the leveraged derivatives, you're really not giving yourself a chance to excel. But with Danielcode, the beauty and poetry of it is so evident to me, and I hope to make it evident to you over time. Its precision and target recognition, absolute delight. And nobody enjoys the Danielcode more than I do, and that might sound strange, as I've been trading this thing in one form or another for well over 30 years, 32, 33 years now. That's derivatives. I was a stocks trader before that, but something, no email reminder of the webinar today from David Samuels. I'm very sorry about that, David. I shall talk to GoTo and see what it is they've been doing. we want to make sure you get every opportunity to come to our tutorials, so that's a fault with GoTo. I'll take it up with them. Okay, let's move on. I hope you're well, David. Incidentally, that's Lockie, good old mate. He's been a Danielcode member for years and years. So the standout messages from 2024, we're still dealing on. Mark L and his fabulous 1,000% plus return on 2016 natural gas, 400 to 600% on margin, the same market. From Justin, Amy and Scott, 500% on Wheat and Russell. And then Justin again with his massive analysis of the Danielcode time trading system. And those of you who attend our webinars regularly will remember that he finished up his second final presentation. He did another one for us. Was greater. He tested greater than 100 years of back testing of all markets, including all the futures and forex that we cover and more, which was a massive, a Herculean job. And we're so grateful to Justin and Amy and Mark and Greg Palladini and all the others who've been kind enough. Of course, our newest star who had a fabulous $5,000 trade in crypto, out of which he netted $200,000 in a matter of weeks using his Danielcode time trading methodology. Wonderful stuff. And we're so grateful to all of those people who've shared what they've learned and what they've seen with the rest of us. So have a look at this. This is the front page of the Danielcode website. And here are the 4 videos from those people that I've talked about. Video 1, that's Mark L. Video 2 is Amy. 3 and 4 are both Justin. And the amount of data and research that's available to you there in these videos is quite extraordinary. Okay, so let's keep going here. And the biggest issue I think we're going to face later on in the year is debt. And this is not an issue that's unique to the United States. All of the Western world has a debt problem. Massive amounts of money are being created as debt. It's really started to get out of hand with the COVID pandemic. Governments overreacted and flooded their various economies with money, and the money supply level has had a mathematically incremental effect to the stage that that's basically what leads to inflation. Inflation, quite simply, is a too much money chasing limited amounts of goods and services. And I think that debt is a real problem. It hasn't been really recognized as such. Everyone's pretty relaxed about it all. The US Fed in particular has been turning itself inside out to be on the right side of Wall Street, being very cautious about what they say about debt and very cautious about how they deal with inflation. So this is a universal problem, and you're seeing it on many, many countries. In Australia, for example, our economy has been so badly managed by these total fraudsters who are the Australian Labor Party, equivalent to your Democrats, but worse, they've got a big infusion of left-wing union bias from Australia's UK migration problem. We've brought in a lot of wonderful Englishmen, and we've also brought in some fairly nasty trade union characters that have infected the country over a period of many years. And some of those issues are coming home to roost. And of course, this is happening in a background of we're about to get the Trump administration. And US markets have never been happier and more optimistic than they are right now. And US equities are healthy, but bear in mind they're being driven by a very small group of big tech companies. Technology in the S&P is now over 40%. And the Trump administration is going to be even more market friendly and extending that largesse to crypto. They've already signaled that, and in fact, the younger members of the Trump household have got investments in crypto and crypto products that they're promoting and marketing. And if you think you've seen the massive increases in the US national debt from Trump 1, Obama 1, 2, and 3, which is really what the Biden administration has been all about, just watch what happens to that debt in Trump 2. I mean, Trump's not a guy who's going to be worried about debt, and he's made it pretty clear that he needs to have access to massive amounts of debt. That was the first thing he asked even before his inauguration. He talked his loyal retainers in Congress to putting up a act to lift the debt ceiling again. That's something the Democrats did a couple of years ago, but that legislation's expired now, and the Republicans are going to have to find a way to deal with that. So this will not be an administration that tries to reduce or limit debt. And the reality is that the US is such a mighty and superb engine of growth, innovation, and fiscal excellence that the power of the US economy hides a lot of financial sins. And I think that's what's been going on. I think it's been hidden. I think there's a serious intent to hide the inflation problem. There's a serious intent to simply ignore the debt problem. And some of those issues, I think, are going to surface later this year. But talk about happy markets. This is the S&P. This is a 6-day chart. And the S&P is not very far off its all-time highs. And then you can look at the next one is the NASDAQ, same thing. All-time highs, not very far off its all-time highs. Here's the Russell. This is the small caps, which usually has had a long period of disassociating itself or disconnecting from the other indices, particularly S&P, NASDAQ, but now it's not that far away. It's made new all-time highs in late last year, and it's not that far away from them now. And there's no real impetus in the market to be selling off anything yet. So we'll see what happens. So this was US T-bonds 24-day chart. This is an old chart I've shown you over many, many years. This is my long-term trading chart for US T-bonds, and as you can see, over the years it's had so many annotations and questions on it that it's actually hard to see what we're looking at. So I'll clarify that for you in a moment. But I may digress for a moment because I have a note here that Greg, Texas Greg, who used to be Colorado Springs Greg, had asked me to comment about correlations. And not so long ago, I gave Greg the website for MSCI, who are wonderful market people, and they publish a continuing record of correlations between all the various markets. And what Greg's noticed is that at some times the bond market seems to be correlated with the S&P, and other times it seems to be correlated with the Russell. And what did I think of that? Well, I can tell you in the 32 plus years that I've been trading derivatives, specifically Forex and futures, I've seen the S&P go up when the Russell goes down about as many times as I've seen the S&P go down when the Russell goes up, or that they both work in lockstep and in harmony. And what you're actually seeing, Greg, is temporary correlations. Markets do correlate. We know that basically all of the equities, Russell, Dow, NASDAQ, S&P, and Germany's DAX, are highly correlated. They're so highly correlated that signal in any one of them can be executed in any other. We know that gold and silver are highly correlated. We know that gold has a traditional inverse relationship with the US dollar index, and it vacillates between having that inverse relationship. In other words, dollar up, gold down, and vice versa, to having a linear relationship where they move together. And for some considerable time now, it's been that they've been moving together. And I did a study many years ago that showed that when that inverse relationship breaks down and turns to the other side, the linear relationship, gold always benefits most, which is kind of interesting. But the gold market is absolutely roaring. It's also not far off its all-time highs, and may even be attempting another run at the all-time highs. But having a look at this chart, so Greg, basically all I can say about the points you've raised is that, yes, these markets have temporary correlations. They like correlations. Markets are happy to be in correlations, but ones we're talking about here, equities as opposed to bonds, they are temporary correlations, and they're not something you can rely on from a trading point of view. Okay, so this US T-bond chart, this is a 24-day chart. Each of these bars is comprised of, excuse me, 24 trading days. And we've been tracking this thing marvelously. Those of you who've been with us will remember how we got very aggressive around the top, the all-time top in this market, and tracked it all the way down with pretty much catching every single bounce as it went. But what I want to draw your attention to is on the complete left-hand side of this market, you can see a great big gap down. And to make that more clear, here's the next slide. You can see I've put a blue oval around it. And that gap is real. This is a gap that happened under the watch of when Paul Volcker was the chairman of the US Fed, and this is often referred to as Volcker's shock. And what it was about, he'd been battling bad inflation, heavy inflation during his term as the president, and he'd been pushing interest rates up and up and up. And at the last point before you got this gap, they'd been moving between 9.5 and about 11%. So interest rates were already very high. What he did next is he rammed up interest rates, first of all to 20%, and then to 22%. And that finally broke the back of inflation. It also broke the back of the market, which went into a recession not too long afterwards. And the big point to think about is this next chart here, because I've taken off all my notes and I've put a line across here to show you, excuse me, that right now the market is pretty much where it was at the end of the big gap down late in 2099. Pretty much there. It's poked its tail through it before here in November 2023. But where it is now, it's pretty much where the market was before it had the Volcker break and the big gap down. So bonds are valued now at about the same price as they were at that time. But remember, at that time, interest rates were 9.5 to 11%. Right now, interest rates are around 4.5%. So there's a complete mismatch between what's happening in the fight against inflation and what historically has been the effects of inflation and how hard it is to get it out of the system. And I believe that there's a lot more inflation going on than anyone wants to admit. And there are all sorts of reasons for that, which we'll come to. But just think about this price of T-bonds. They're about where they were late 1999, but in interest rates there were 9.5 up to 11, I think 0.2%. Right now they're around 4.5% at exactly the same price. So what's the difference? Well, part of the difference is this big run down or correction in T-bond prices from March 2020. This is what caused a fair bit of drama in the banking system, and some of those banks that went insolvent, Signature Bank was one of them. And what's about is that as the price moves down in this particular chart, interest rates are increasing. That's what it's showing. The price of the bond is inverse to the interest rate. So as this market's had its big swoop down, interest rates were increasing all the time until very recently. And those losses on the value of bonds was absolutely staggering in the banking system. So what did the Fed and the government do? Well, they said, let's change the rules. Let's say that you can hold 50% of your bond portfolio. You can declare to us that it's held until maturity, and you don't have to value it at market now. So the vast majority of UST bonds are not being marked at market, and this was the whole problem that arose in 2007. Those of you who have long enough memories, is that the CBDs, collateralized debt obligations, CDOs, and the mortgage security interest were not being marked at market, and there was a total giant conspiracy about that until eventually the dam broke, and that's what caused the banking dramas into 2009. And it looks to me like we're setting ourselves up for the same thing, because to have interest rates at 4.5% when this market, the bond market, is pricing in something much, much higher, seems to me a nice little issue to just fester away and fester away. It looks quite stable at the moment, and we will see. But to me, there's a great big red flag waving over the top of all that. And Needham's rules on conspiracy theories is basically most conspiracy theories are true. And the very best conspiracies are those that nobody sees as a conspiracy. And stock markets are based on conspiracy. That's come as a shock to most of you, but it's an absolute fact. So US equities are inflated by the massive success of the big tech companies. And the S&P 500 is a free float adjusted market cap. In other words, the bigger the size, the capital of the market, the more weight it has. In other words, it is constructed according to market capitalization. And technology is now the largest sector of the S&P 500, and it could be worth as much as 400% or even more. And all of this massive, massive growth that we've seen in the S&P, a vast majority of it is attributable to these big tech companies that have been so brilliantly conceived and managed, that have been the original disruptors and the ability to capitalize on that. And Trump has recognized that. You might have noticed, those of you that are reading anything about the inauguration, that he's got some of the major tech guys who've been down to Mar-a-Lago and paid their homage to him and mended broken fences, as clever people would do. They're actually sitting with him. He's got a special place for them on his dais for his inauguration. And he's got Musk, of course, who's officially the best buddy of Trump. He's got Zuckerberg. He's got the TikTok guy, which is kind of interesting. Those of you who follow these things will know that the court is being asked to enforce a wind-up of TikTok to stop the it's a Chinese-owned company that owns it, ByteDance, it's called BYTE, and there's a lot of concern about private information being harvested by the Chinese. So Trump was violently against TikTok, until he had a meeting with their senior executives, and he's now violently in favor of TikTok and trying to find a deal to keep it going but satisfy the critics to an extent. So that's why you're seeing the chief executive of TikTok sitting in this particular loading of all the high-tech guys that are going to be with Trump and who have paid massive amounts of money towards the cost of this inauguration. So that's one of the subtleties of the S&P. Let me move this over. And there's part of the conspiracy. Public companies join stock markets primarily to raise capital. And these indices are sponsored by various groups. The Dow Jones Index, of course, is sponsored by Dow Jones Corp, S&P by Standard & Poor, NASDAQ, etc. And S&P, which is going to be the big worry in my view, has about 40% plus of that index is technology. It's the rocket booster from the big seven tech companies. And I think that's also going to be its Achilles heel. So governments everywhere see stock markets as virtuous institutions created for the free trading of securities. And of course, they're nothing of the sort. Government has limited knowledge of markets, so they seek advice. And that means the big stock and share brokers are basically setting the rules. Government regulations make it almost impossible for the average stock investor to short equities. You can short equities, but you've got to borrow the stock first and go through all sorts of other obligations. But in general, there is a constant PR campaign that stocks are good and virtuous and futures and Forex are evil. Excuse me. I was at a function the other evening, which is very unusual for me. I don't generally attend functions. But I was talking to a chap who was a very keen ETF trader. And I just mentioned to him on the side, had he ever thought of trading futures? Well, he exploded. Oh, my God, I'd never do that. They're evil. They're dreadful. They ruin people. They shouldn't be allowed. It's the end of the world. And this guy got terribly emotional about it all. And that is proof of this constant PR campaign that stocks are good and futures and Forex are evil. And it's a real crying shame because the ability to make money in futures and Forex is such an outstanding thing. It should be being taught in every school in the world. And of course, it's not. But it's a shame that an entrenched group of opinion makers, the stockbrokers, the big firms in particular, have got such a huge and complete sway over this industry. Okay, so think of the most basic measure of inflation. It's what we see every day. It's the price of food, it's the price of gas and other fuels, the price of all supermarket goods and how the packaging can be fraudulent. You know, they've all been at this trick of leaving the price the same, but they're actually giving you slightly less product. The price of electricity and the semi-monopolies involved in that. Everything you can think of as an everyday expense. Now, think about the US Fed and other central banks. They've excluded every one of these everyday items from the calculation of inflation. I mean, this is the economist's wet dream. Oh, they're too volatile, we'll exclude them. That's the point. That's why households are getting hit so hard, and that's why the Fed and the regulators are just blithely indifferent to it all. They simply don't see it, and their tools have been adjusted to make sure that those items that are the most vulnerable to inflation and show up straight away with inflationary expectations, they're excluded from the calculation. And add that to the fact that these debt instruments are now valued differently, and in particular I'm talking there about bonds, the special rules for banks and other security holders, how they can value bonds, which have had a spanking, absolute spanking their dollar value, because as interest rates go up, the price of bonds goes down. And that's all been concealed. It's like everything else about this. So inflation is a beast. It's a hidden tax on the public. And over the years, we've learned that inflation is sticky and hard to kill. And the Fed knows most folks are short-term thinkers. The whole inflation issue is too hard for most people to even understand. Our general population, you've only got to watch the rubbish that's on cable TV to realise they're selling what the public wants, and it's appalling, isn't it? But they've created a consensus that US inflation is benign and under control. Indeed, the Fed, as you all know, actually started to reduce interest rates in their belief that it was all fixed. Volcker's experience gives us a salutary lesson. It's hard to budge inflation. Think about inflation as simply too much money chasing limited amounts of goods and services, and think about the insanity, indeed the sheer fraudulence, of Biden's Inflation Reduction Act, which had nothing to do with inflation reduction, was just the next great Democrat scam to just flood the system with money. For pet democratic means. And how that ever got through Congress is a mystery. But no one worries about it much. So here's a note on Paul Volcker. Greg from Texas, lately of Colorado Springs, was kind enough to let me know that I'd got the date wrong when this great leap of Volcker's happened. So here's a note from Wikipedia on Volcker and what he did. You can read all about it there. It's an interesting part of history which I believe is doomed to be repeated. Okay, what I'm showing you now is on our website on the home page. It's the 2025 S&P forecast of the fourth seal from Danielcode by Frank De Baere. And Frank, as you know, many of you know, he covers gold, crude oil, and the S&P. And he gives us a weekly commentary on how the fourth seal is affecting those markets and what can be expected from it. And it's a wonderful article. I hope you'll take the time to read it. It really is wonderful. And this is a bit of it. And you can read all this for yourself. And Frank came to see me as a young man. It was 2011. And he brought his then fiancée with him, Anne. He was a very young man, and I guess I was younger then too. Just hold the line a moment, folks. Do forgive me. My apologies for that diversion, folks. Dogs. Those of you who have dogs will know that when dogs got to go, they got to go. So that was one of my dogs. I'm fortunate enough to have two of almost everything: 2 children, 2 dogs, and 2 cats, which are not mine, but I've inherited them. My son brought them home and then took off overseas for the last 3 or 4 months. So Dad has to look after the cats. But anyway, I had to let one of my dogs out. Your dog owners will understand that. People who are not dog owners will say, how bloody ridiculous. Anyway, there is Frank's comments. I gave you a chance to read it all. And basically, he's given us 3 dates in 2025, and those dates are when the probabilities combine to increase the odds of a final top in US equities. And one of those dates is not very far away at all. You can read Frank's analysis of market time based on Danielcode fourth seal theory. And after you've read Frank's latest article, you need to get subscribed to his weekly commentary here at Danielcode. As I said, he covered S&P, gold, and crude oil, and his coverage of the S&P, his weekly coverage now is getting quite critical. So why, when things have never looked rosier for US equities, are we warning of a probable top? Well, what we've proven over many, many years is that these Danielcode time cycles dominate all markets. They don't seem to give us a reason necessarily. Before the .com top in 2000, things looked very rosy. Before the 2007 top in the S&P, things looked very rosy. But the time cycles dominate the major moves of these markets. So it's at least worth being aware of the probabilities. Being educated means being aware. You don't want anything to be a surprise when it happens. So at our last webinar, I set for you the Danielcode challenge, and I heard so many stories about what traders were doing and what they were achieving. I wanted to set a challenge to find out how effective their trading strategy really is. And most of you are underperforming. I've written to all of you that contacted me about that, but there's a whole lot of people that are happy with their trading, and they're simply accepting the conventional view of futures and forex trading as a slightly superior methodology. And many of you who are regularly returning 25 to 45% on margin per annum are happy. And most of you are trading price and haven't yet made the jump to trading time or even fully investigated what Danielcode time trading is all about. But it operates on a wholly different parameter. Think 400 to 600% on margin across all markets. If you'd like more detail on that, go to those 4 videos that I referred to earlier, and you can see some of the pretty important work that some of our members have done and are happy to share with you. So remember also that the greatest gift of markets is volatility. It's true to say market selection is probably the most important criteria on profitability. And volatility is like waves. It comes and it goes. And our tutorial favorite is natural gas for 2016. This is a piece of paper trading or back testing your strategies, and I ask everyone who does the major Danielcode tutorial to do this, to backtest their strategy on natural gas for the whole of 2016. And this is where Mark L., who I'm sure is with us today, he never misses. He returned over 1,000% on margin for that market. Now, part of that was a wonderful, wonderful gift of volatility. Using exactly the same system for 2015 and 2017 calendar years, the net return was about 55% of that. In other words, a whole lot of that super boost came from a super volatile year where we had some wonderful big moves. Okay, so bear that in mind. That was the Danielcode challenge. And this is the teaching that we have 2 methods of teaching now, 2 entirely separate methods of treating. One is the old-fashioned, if you like, one-on-one sessions with me. You can be having anywhere from 6 to 10. I think one of our chaps is up to 16 tutorial lessons now. Gabe, over in California, has had some problems with getting his grips on it all. He understands it, he just can't quite articulate it into his orders, but we keep working with him. We're here to do that. And that's one method of learning the Danielcode, and I'm particularly talking about Danielcode time trading. That's the biggie. These guys who are talking about 400, 600% and more on margin. That's what they're trading, Danielcode time signals. We have then, realizing that that was fairly expensive, we bought in a new, what we call the TTT, Teach Yourself to Trade. It's a video series, which we've been offering for a little while now, and it runs at a much, much cheaper price point because it hasn't involved me so much. So interesting that this Mike Kay, who's a new member, he's actually an old member who's joined again. He's a Kiwi guy, lovely guy, and absolute delight. And at this challenge, I said, let me know, apply your trade strategy to this market, natural gas 2016. And Mike had just bought the TTT version in late November, and he was working on it in December. That's the Teach Yourself to Trade video series at a much, much cheaper price than the full one-on-one tutorial with me. But he'd only been working on this for a very short time. He bought it late November, was working on it December, and in early January he took the challenge that I'd posed, and he came away with absolutely marvelous results. And that's important because it's showing us that here are some of his results. And this is what he got just from the TTT, Teach Yourself to Trade video course. And he would got himself up to a 774% profit margin. And he did that within a month of really starting to work on it. So it's wonderful proof that the TTT course is dynamic, that it's effective, that it is distributing to you all of the information that you need. And as you'll see, I'm going to back that up by making it a little bit better for you. One of the things that Mike wrote about there, and you can see his full post on the website at www.thedanielcode.com. He said he was a bit sad to see winning trades turn into losing trades. Well, that's a function of the program. This Danielcode time trading program is, to the best of my knowledge, by far the safest and best trading program that I have ever seen or even heard of. And we've been doing this for quite a while now, and nobody's jumped up to say, hey, I've got something better. And these are talking about the multi-100% return on margin. So one of the points I'm going to make to Mike, and I like to make to you, is making it even better. Well, I don't think at the moment we have a viable strategy to increase the returns of the Danielcode time trading program. However, we do have a strategy. It's called Beyond Masterclass. We do have a strategy which highlights the optimum times to be trading and the optimum times to move your stop away and give the market room to breathe in the expectation of getting a bigger return. And one of the interesting things that's come out of that is a couple of entirely new and entirely different trading systems. And I was talking to Gig on Monday this week, and Gig's a wonderful man. He lives in North Carolina. At the moment, it's got a bit too cold for him, so he's gone down to his other house in Florida, where he's enjoying some better weather. But Gig's done the full Danielcode Masterclass trading tutorial, and he was taking the new Beyond Masterclass tutorial, which comes in two parts, and he was doing the first part last Monday. And what I showed him was one of the new interesting little programs that's popping out of the Beyond Masterclass trading. It's what I call the red line trade. And that's got about a 90% win rate. And it has lots of trades in all markets. It's a universal trading tool. And it was interesting because Gig and I were getting at the stage of just laughing about it. To take this trade, there, exit there, take this trade, exit there, take the trade. And they just were coming in one after another after another. It was quite extraordinary. Folks ask me about the Beyond Masterclass trading systems. To do that, you really need a full understanding of trading Danielcode time. Because without that, your entries and exits, I doubt, will be flexible enough to absolutely categorize on it. But if you've done the Danielcode time trading tutorial and you want to go to the next level, let me know. We haven't yet created a Beyond Masterclass course for the TTT guys, but I will. It's a question of making time to do it. So if you're interested in that, do please shoot me an email and I'll be happy to talk to you about the possibilities there. So get signed up for your tutorial, folks. There's a lot of wonderful stuff happening, and it's the quickest way I know to get you people happy, healthy, and wealthy. And a bit more money coming in is good for your health. Remember, yes, its cost is considerable, but this is a lifetime skill. You can trade like these guys have every day. One of these guys I'm talking about, we call him CE. I talked to you about him at a previous webinar. He learned to trade time, Danielcode time signals on futures. We never looked at a crypto chart. We taught it on futures, which is the most subtle of all the markets, is the futures market. And what he did, he went away and took a $5,000 account and turned it into $200,000 on a crypto trade just over a few weeks. And he was thrilled to tell us that he used the Danielcode Masterclass technique to enter and exit, and he used the Beyond Masterclass technique to hold on to the trades for the optimum period. So remember, all markets trade exactly the same on Danielcode time signals. If you learn to trade futures, you will also be a super Forex trader. If you learn to trade futures, you'll be a super crypto trader. They are all exactly the same. They all work identically on Danielcode time cycle. So whatever you're interested in, let me know. I'll be happy to teach you it all, or for you to learn to teach yourself to trade with our new video series, TTT we call it. So they're basically 4 lessons. You can read about what they are right there, and you can see the link at the bottom of that page. Sets out in more detail what these various lessons are. It's very simple. You just tell me which ones you want, and you have a free trial. Open a members account with the Danielcode, and your videos, whichever ones you purchased, or all of them is even better, will appear on your members page instantly. Instantly being as soon as I get around to doing it, which is pretty damn quick most of the time. Okay, so the other one, of course, is our standard masterclass tutorial. That's the big one. You do one-on-one with me. You've seen these wonderful testimonials before from Mark L. and Greg Palladini. It is real, folks. If you're not making these big 100%, 400, 500, 600% and more from trading Danielcode time signals, you are missing out on something that you don't have to. I'm here, I'm alive, I'm reasonably well, and you get these, either you can have a one-on-one tutorial with me, or if you prefer, you can have the very much cheaper TTT video series, and to that, I'm actually going to add a new offer for you. I know you like new offers. The Australian dollar is still very weak against the US, so I'm still able to offer you a $1,000 discount if you're ready to start your big Danielcode Masterclass tutorial. And if you're going to use our Teach Yourself to Trade video series, when you buy the whole course of the 4 videos, I'll add a 90-minute teaching session one-on-one with me, so that will tie everything together and answer all of your questions, all at absolutely no additional cost to you. Email me, jneedham@thedanielcode.com. to secure your positions. Okay, momentum bars. You've heard me talk about these for quite a while now, and I'm very, very excited about them. And they're now forming the basis of this Beyond Masterclass tutorial. The use of Beyond Masterclass to identify these extraordinary patterns which depict the extremes of moves that remain within a notional trading envelope. At these extremes, markets must react. And one of those reactions is the start of an important trend. So do ask me about Beyond Masterclass if you feel you're familiar already with the Danielcode time trading. It really does. It's not a new trading system. The Danielcode time trading is the system, but this is a way of optimizing your returns by holding selected trades for much longer periods. It's pretty fantastic. Okay, finally, let's have a look at what's been happening this week. As I said, markets have been a little bit stunted, a little bit muted. Today in particular, they didn't seem to have much strength about them, but I think we've caught every turn that you can possibly think of. We've caught them all. As I said, by Wednesday, I was running out of Forex markets to have signals on because we'd picked all of the turns. And I don't have any Forex trades to show you because Trade Navigator are not supplying intraday data on Forex. So at the time I do these for you, which is sort of 4 o'clock on in my morning, you don't have access to that intraday stuff. But these are our last couple of trades in crude oil, 3,000 up and another almost 4,000 up. Nice bit of trading. This is the S&P. It's kind of interesting because there's been no violence in any of these moves apart from the one big bar down soon after the start. You can see that there quite clearly. That's the only suggestion of violence we've had. And we should really be seeing some more violence in this market. At the moment, it's sort of in semi-snooze mode. It's just correcting both ways. But with nice trading, we've got some good profits out of it. This is gold. We've had 2 huge trades in gold and 5,700 for where we are in the last 2 days. It's pretty interesting trading, isn't it? Get yourself educated on Danielcode time signals, folks, so you can create these trades and have the benefit of them for yourself. This is copper, which has been on a wonderful drive. It's one of the few ones that still had good impetus today, and we had a buy signal just above the low, and then we had a flip me signal for the continuation, and we had 5,600 odd on the first leg up and 2,000 for where we are in the trend right now. This is the NASDAQ, which looks very much like the S&P as you would expect, and we had just had the one trade straight up into today's close, $5,600, pretty nice. Here's the Russell. His pattern is a little bit more complex, but we've had a nice trade in that as well. This is Beans. Interesting what Beans is doing. We had 2 sort of muted moves, one up, one down. We made 2,300 on one of them, 1,100 on the other. It looks like there's volatility on the chart, but there's really not. This market is just thinking about things to quite a serious degree. That's fine because you'll be with the trend if you're trading Danielcode. Markets can't move without us. Here's silver. Nice little buy trade into today's close. Put a bit more money in the bank. And here's wheat, which is, in some ways, this pattern in wheat is not dissimilar to what's happening in the equities. You think about what I've just shown you in the S&P and the NASDAQ. This wheat market is not dissimilar, is it? Anyway, we had a nice short trade day before, not today, yesterday. We had a short trade. And it's made some money. This is wheat. It's a very small market. It's actually a very, very good trading market. And here's the one that's got me thinking about it all the time. This is US T bonds. We had a TO3 and blue line buy. They're the strongest signals we can create. At that low, we actually had it the day before the low, and what you see is an outside bar only went one tick above the true high of the previous bar, so we didn't get pulled into that, but the signal was repeated. It's valid for 3 days, including the day of posting, and that's what got us long on Monday, or was that Tuesday, whichever after the outside bar. The outside bar did not pull us into the trade because it only moved one tick above the previous day's true high, and we require a 2-tick buffer on all our trade entries, 2 ticks above and 2 ticks below. So learn to trade the Danielcode time signals. It's the best trading program I have ever seen or heard of. It will make you an elite trader. And folks, if you haven't already, please go to my website, www.thedanielcode.com. Start your free trial. Just hit the register button. Any issues, contact Terry at support@thedanielcode.com, or me, Jay Needham, at thedanielcode.com. And that's pretty much me for today, folks. I hope you've found what we've talked about interesting. I hope you're thinking about the ramifications, because we are moving into a time frame where there is substantial probabilities for a negative movement in the major US equities. So understand it, try to learn it, be on alert. This is our disclaimer, which I ask you to read, and be careful. If you do not know how to trade, it's very easy to lose all of your money very quickly. The good news is, once you have learned how to trade properly, presumably by doing a Danielcode course, you will be able to make a whole lot of money very quickly as well. And with us, that's us for the day. I hope you've enjoyed it. It's been lovely having you with us. Rolf is here. He's been swanning about in New Zealand with his family, having a great time. And he's back working and back in Melbourne now. Glad you enjoyed it, mate. Have a good weekend yourself. Okay, wonderful for everyone who's been with me on this journey. Thank you for being with us, and I look forward to seeing you at our next webinar. Any particular issue you'd like me to talk about, just send me an email, jneedham@thedanielcode.com, and I will be happy to put something in place. Bye-bye for now.